Hello and welcome. Today we are going to talk about the 5 do's and don'ts of raising additional working capital for your business. For those of you who may not be familiar, working capital is the money that you use to run your business. It's not, that's the simple definition of it, but it's composed of different things. There is equity as well as debt, and we're going to talk about typically, when we're talking about working capital, we're typically talking about equity investors. And we'll talk about why in just a second. That's just the most common thing. If you're new here, my name is Taylor Darcy from Think Legal, where I help you create the business of your dreams. So welcome. I'm happy you're here. Also, keep in mind that I go live every weekday, except for holidays, at 11 a.m., and to discuss the issues that we have to help you build your business the way that you want. So please don't forget to subscribe and like so you get notified when I go live, so that we can help, so I can help you and give you what you need to grow your business successfully. Let's get started. Now we're going to do this a little bit in reverse order, in the respect that we're going to talk about the don'ts first and the do's last, because I always like to leave stuff on a positive note. So please keep that in mind, that the reason why I do this is to make sure that you're remembering the most important part. Number one of the don'ts, the first don't, you don't want to just keep or start by asking for money. There's the wrong way to go about it, and it will end up hurting you in the long run, because you won't know what you won't know, and you want to be super educated on your business on several factors. You want to have a complete and well thought out business plan, including financials and analysis that support the amounts in question, the amount that you need. What is the return on investment? What is your weighted average cost of capital, or your WACC? You need to have a 2-page and the full plan. Each page, each version should get like whetting their appetite for more. You want to kind of tease them with the first one, tease them with the second one, and then when they have time, they'll review the full plan. The last thing you want to do is have them sending them the full plan when they may not have any interest in what you're doing, and it doesn't really spark them, especially if you create a plan this thick. The next don't is don't ask for too much money too quickly. Bootstrap until you can't grow. Bootstrap until you can't grow without it. You get the additional capital. And the reason why this is so important is that you want to create as much value for the potential investor as possible. The way that they handle the money, the way that they look at things is very transactional. They want to know what's in it for them. And if you can't demonstrate through your own financial prowess, obtaining using your own money, your own debt, your own credit cards, your own money, they aren't going to want to invest with you either. So, and then there's also people that seek the capital too quickly, typically don't have as well of a thought out business plan. They don't have as solid of a business, and they also give up too quickly. They give up the equity too quickly. And that means that later on down the road, they don't have as much say in what happens with the money and the profits and the revenue. If you can bootstrap all your way to success without getting investors, that ideally is your best bet. Because then you get to keep all of the investment. You get to keep all of that money for yourself. I'm not suggesting that you shouldn't. I'm not suggesting that you can't. I'm simply saying if you can bootstrap your way to success, you will be so much happier than someone that gave away equity too quickly. The idea between too many cooks in the kitchen, so to speak, applies a lot when it comes to business. The next don't is to be inflexible to how you get your money. If something doesn't work, then try a different way. Okay, don't rely on being so set in a specific way that you can't look at it from a different angle and say, okay, that way of getting equity didn't work. Let me try this different way, or not equity, capital. So just keep that in mind, that you want to be very flexible in your approach and be very specific in what your goal is. Now, I know this is going to sound funny because I said don't ask for money too quickly, but you also don't want to wait too long, because it takes longer to get the capital than you might like. And so what ends up happening, you really need to approach this from a Goldilocks perspective. What ends up happening is if it takes too long and you don't get the capital that you need, then you don't have another way of getting it, and it ends up hurting you. And if you're truly in that position where you need it, it could thwart your business and could cause you some serious issues, laying off people, closing things, just things that you don't want to do. You want to do it right. You want to find your sweet spot of when you don't have to have it, but you need it to get to the next level. And you should be doing this through your business plan, financials and cash flow and analysis that goes with that. It's really a balancing act between too quickly and not quick enough. Because if you start 6 months too late, then it can hurt you. And if you start 6 months too early, then it can hurt you. So you really want to nail down when it is you're going to need it. And this comes from having a well thought out business plan, lots of analysis. You're going to know this ahead of time. You're going to have done your due diligence already so that it's not a surprise when you need the money. So keep that in mind, that it's not always, that's the whole purpose of the business plan. It isn't just for investors. It's for yourself to make sure that you're on track with your goals in that respect. The next thing that you want to do is to take too much of your potential investors' time. Most angel investors are very, very, very busy. So the short, get to the point. Okay. The warm and fuzzies investors like a little bit of the dog and pony show, but they really want to know what your money is, right? That's the purpose. That's their goal. And so you really want to focus on what's in it for them. And that should be your business plan, with the mind that you, as the owner, business owner, is the primary investor. So it should be geared towards people like you, that you aren't in business just for the sake of being in business. You're in business to make a profit. You're in business to build your product line. Keep those types of things in mind as you're doing it. So don't take too much of your investors' time. Think of it as giving them the Reader's Digest version of things. I don't even know if the Reader's Digest version exists anymore, but the idea being, keep it short, keep it simple, keep the analysis tight. Ruth Bader Ginsburg said, keep it tight, get it right. Don't use 5 sentences when 2 sentences will do. Don't use 30 pages of exhibits when 5 exhibits will do. Now, analysis, on the other hand, if you can show methodology through your financials and analysis of your market and analysis of these things, those are all good and valuable. If you're just showing a bunch of graphs and a bunch of pie charts and things of that nature, that's not really analysis. Yes, that's pretty, but it doesn't show how they got there, how it got there. And that's really what the investors are interested in knowing, is how you got to your numbers and why they should invest with you. Remember, what's in it for them? Short, sweet, to the point, teasing them with their your 1-page business plan, teasing them with the 2-page business plan, teasing them with or giving them the full plan, and being very detailed in that plan. All right. So let's talk about your do's. Sorry. Now, these are a little bit more, I don't say nuanced, but they're a little more like, yay. So one of the things that you want to do is, when you're approaching investors or you're approaching your financials for your money, you want to start with the idea that rather than trying to get lump sums of things, have staged investments or staged money coming in, so that as you're meeting goals, because this does 2 things. Number 1, means you're not using more money than you need. And number 2, you're building trust with your investors, right? If you're meeting these targets, they're going to be very happy to give you more, but you don't have to take it. But if you take a lump sum of investment, then it's all gone, right? And you could potentially lose, and they could potentially lose. It lowers their risk. It improves trust. It's a smart way to do it. It all around, it just makes a ton of sense. So you want to make sure that you're doing staged investments so that people are, it's a healthy, good relationship. Okay. Next thing is, you want to make sure that when you're planning, part of your business plan should be bringing on your strong management, focusing on your sales, focusing on a good customer base. Hypotheticals, and this is why Shark Tank is so funny, because hypotheticals will only get you so far. Yes, there's projections, and that's fine. But your history data is more valuable in that respect than your hypothetical projections. And here's why. You don't know what's going to actually happen, right? You don't know that the economy is going to tank because of COVID-19 like what we're currently in the middle of, or whatever. You don't know what's going to happen. If you'd have asked a year ago what was going to be happening this year, nobody would have said, "Hey, we're all going to be fighting a pandemic." The idea being, you want to make sure that your hypotheticals are minimum and that your actuals are there, like your past data based on these things. The more the better on that respect, because here's the thing. People can survive a year, 2 years, 3 years by sheer will. It's a lot harder to survive 5 years. And that's really the magic number in entrepreneurship. Most businesses don't survive past 5 years. So what you really want to do is making sure that your numbers are based on as accurate of data as possible, historical, non-hypothetical. That isn't to say that you can't do any hypothetical, but be conservative. It's always better to deliver, under promise and over deliver, is what I like to say, than it is to over promise and under deliver. And so you really want to make sure that you're getting a strong management, sales and customers, and your hypotheticals are to a minimum. The next thing that you want to do is, and these are questions that you're going to want to answer for yourself, but also for your potential investors. How much can they make? Again, it's all about the money. How much can they lose? That's an unfortunate truth. A lot of entrepreneurs lose a lot of money, and they're fine to do it as long as they're aware that that's going to happen or possible. What is their exit strategy from their deal? That's the most important thing. That's one of the most important things that they're going to want to know, because they don't want to necessarily stay in the deal forever. They want to get their money, get their investment, and get out. They don't necessarily want to stay in. Some do, some don't, but again, it's still very important that you're talking about exit strategy. Who else has said this deal is viable? So have you had multiple people that have looked at it? Have they said yes? Have they said no? Who have said yes? And why have they said yes? And those are very important, because if it's a bad idea or if it's a bad investment, you're going to have a lot of no's. Now, there might be some that'll take a yes on that, but keep in mind, you really want to make sure that you've got some credible sources or credible people that are willing to take the investment opportunity. As the founder and others, have you tapped other sources of our people for resources? And what is their risk? How much are they risking already? What other value besides money can the investor bring to the table? So, yes, it's typically about the money for them, but a lot of these angel investors and venture capitalists want to make a difference. It's mostly about the money, but they want to see what they can do. And so bringing their mentorship and bringing that type of value to you is important to them as well. If you've got everything sewn up to the point where you literally just need them for their money, and I use this loosely, a bank is probably a better option in that respect. The debt is cheaper anyway. And the reality is that then you don't have to worry about them having a say or any type of issue with how you spend the money. The next thing is, can they trust the management team? So having, like I said, all-star management team to make sure that the money is going to be used appropriately, wisely. Do they have experience in these types of things? Have they done it before? What's their resume like? Is this something that's realistic for them to do? Is the target market large, growing, not stagnant or shrinking, and reachable? So these are questions that you have to have answered. Is the target market saturated? That's another consideration. Do you have a ton of people already doing it? Are you in the bread aisle? I've talked about how, if you think bread is overpopulated, there's plenty of different types of bread. So that it shouldn't be discouraged, but there needs to be sufficient demand for it. That's really what it comes down to, is there needs to be enough demand that if you're adding to the market, that you can get the help, that you can differentiate. Do you have what's called a sustainable competitive advantage? What is it that makes you unique? Why should they buy your bread over somebody else? Why is your product, your service better or different than somebody else? Is it you? Is it because this new product has this extra fancy something that nobody else has? Great. Is it sustainable? And it doesn't necessarily mean that it's going to be sustainable forever, but is it going to be sustainable long enough to get you to the next level? Is it going to be sustainable long enough to get you to the next investment, or get their exit strategy, that whatever it may be? So it doesn't necessarily be that it has to be sustainable forever. It just needs to be long term. It needs to be longer than a few months. The last question that they're going to want answered is, the company financials credible, verifiable, efficient, and sustainable? So these are all things that you're going to want to bake into it. Again, conservative is a better option. If you're getting a good ROI with very conservative estimates and very good past history, that's a lot stronger of a position to be in than it is to be risking the investor's money unnecessarily without foundation, right? The next thing that you're going to want to make sure is to be persistent, creative, and focused. You can't give up just because it takes time to get there. It's going to take time. This isn't trench warfare. But the more creative you are, the more persistent you are, the more focused you are, the more likely it's going to happen for you. So it can't just be something you're flying whenever you feel like it. It's all good. I'll get to it. Or it's just money that it would be nice, right? And you're happy to just leave it on the table if you don't get it. No, you need to be persistent about it. It needs to be something that you strongly want, that you're looking at getting, and that it's important for you to get, that you need it to take it to the next level. The next and probably most important do is make sure your due diligence is done on your investors. It's a two-way street. They're going to do it on you. You should do it on them. Because the last thing you want to do is get into business with somebody that has a history of making bad choices or is hard to work with, unwilling to follow your model, unwilling to follow your business. Now, are they going to make improvements? Are they going to help you? Yes, that's not the same thing. But if they're so difficult to work with that all they want to do is take over and micromanage your job, then it's probably not a good fit. Part of what makes them good angel investors is that they're not necessarily going to have a say in what happens in the day-to-day business. So you're going to want to make sure that you're doing your due diligence, because money is only one part of that. Remember, they want to be involved. And if they're a bad fit because, yes, they have the money, but they just want to hurt you instead because of it, then that can have negative consequences as well. So these are just 5 of the do's and don'ts that you want to make sure that you're doing to getting working capital for your business. If you've gotten value out of this video, don't forget to hit subscribe and like, and we'll see you later.